All right, let's get into first in, first out. That's an inventory valuation method, also known as FIFO. We're going to assume it's a perpetual inventory system where the inventory is being updated constantly by the merchandiser. Here's our example. It's LMNOP company's beginning inventory sales and purchases data for t-shirts for January are as follows. So you got a bunch of transactions there. You got beginning inventory, purchases. You got a sale, another purchase, another sale. In all these problems, you're going to be asked to find total sales, cost of goods sold, gross profit, and or the ending inventory. So let's get into it. Let's start with the journal entries. The journal entries are pretty simple for the perpetual system. Let's start with the journal entry for purchases. They're always the same in respect to a purchase on account. The key is finding the amount. So your debit, if you again assuming a perpetual system, is merchandise inventory. And that is for the cost of the merchandise. And if it's on account, of course, our credit is accounts payable. Again, that is for the cost of the merchandise. And it's like that all the time, as long as it's a purchase on account and it's under a perpetual inventory system. Now for sales on account, this usually requires 4 accounts. The first one is accounts receivables. Now you're going to expect money from your customer in the near future. This amount is what you're charging the customer for the merchandise. And then you're also going to record sales to recognize the revenue because you provided the goods. Next, you're going to record the expense related to that sale, which is called cost of goods sold. Sometimes it's referred to as cost of merchandise sold. And then because it's a perpetual system, we have to keep track of the inventory increasing and decreasing. And in this case, it's decreasing. So you're going to credit merchandise inventory. The cost of goods sold in the merchandise inventory is for the cost of the merchandise, how much you got it for from the supplier. Now, to get all the values for the journal entries, we're going to have to do some calculations here. So we're going to do that when we find the sales, the cost of goods sold, gross profit, and the ending inventory. I like to set up a chart to organize everything and keep track of everything. There's going to be 4 columns. The first column is the date. The second column, we're going to track the purchases. And in the third column, we're going to track the sales. The very last column, because we do need to keep track of the inventory going up and down, is inventory. You're always going to update that very last column. Okay, so our first transaction is on January 2nd. And it's not really a transaction because that is inventory that you already had, and that inventory is valued at $5. If it's a brand new company, then you would not have any beginning inventory. Now on January 9th, we bought some more inventory, the same type of product. The supplier sold it to us for $6 this time though. They increased the price. So now we have 15 at $6. So total current inventory, the same item, you have 25 units, but valued at different amounts. Finally, on January 12th, we have a sale to a customer. So right here, you sold 12 units, and we're using first in, first out. So that's the older inventory will leave first, or is sold first. So that older inventory is 10 at $5. We need 2 more, and we'll pull from the 15 at $6. So we need 2 at $6. Right now I'm going to update the inventory. The 10 at $5 is all gone, and there's 2 at $6 that leaves. You want to keep track of what's still there, and so right now we still have 13 at $6, and the 10 at $5 are all gone. So let me put down 13 at $6, because you still have that inventory there. Now, on the 18th, January 18th, we purchased some more inventory from the supplier. The supplier again raised prices, so instead of $6, now we're paying $7. And this time around we bought 20 units at $7. And currently we have 13 at $6 and 20 at $7 on our inventory. Finally, on January 29th, the very last transaction date, we made another sale of 18 units. So right now you want to pull from the older inventory, which is 13 at $6, because again, it is first in, first out. The older stuff leaves first. So it's 13 at $6. We need 5 more at $7. So you're going to update your inventory. 13 at $6, that's all gone. And of the 20 at $7, you're going to minus 5 at $7. Now let's update our inventory. The 13 at $6, they're all gone. Okay. And that will leave you with only 15 at $7 for our updated inventory. Now we have this chart set up. We could solve for the sales, the cost of goods sold, gross profit, and ending inventory. So let's start with the total sales. That's the easiest one because you are charging your customer $30 each. So as long as we have the sales column, we know how much we sold. In this case, we sold 12 and 18 units. So let's list them separately. So we sold 12 at $30, and then we sold another 18 also at $30. This amount right here that we're calculating, this is what your journal entry is. So the 12 at $30, that's $360. If you go back to the sale portion where you recorded sales and or accounts receivable and sales, well, for the 12th, you'd record $360 for both those accounts. And on the 18th, you'd record $240, again, for the accounts receivables and for the sales. Now let's calculate total cost of goods sold, which is the second part of that journal entry, which is debit cost of goods sold and credit merchandise inventory. All you have to do is look at all the ones that decreased inventory, every line item that is in brackets. That will give you your total cost of goods sold. So first we had 10 at $5. Then we had 2 at $6. We had 13 at $6. And then finally we had 5 at $7. Now for those first two, 10 at 5 and 2 at 6, that was when we sold 12 units. So this is what you're going to record for your cost of goods sold and your merchandise inventory. Those amounts, 50 plus 12 for that date only. Now if you wanted the total cost of goods sold, you just add them all up and you'd get $175. Problems will either ask you for a specific date or for the cost of goods sold or the total cost of goods sold. Now let's get into gross profit. If you recall, that will be sales minus cost of goods sold. That will give you the gross profit. That's the general formula from the multiple step income statement for a merchandiser. So our sales, we already figured that out. Our sales number is $600. And our cost of goods sold, we also figured that out, is $175. You take the difference and that will give you your gross profit of $425. Lastly, we want to calculate our ending inventory for January for this problem. Our ending inventory, if you set up the chart nice and correctly, well, that's what we still have in the inventory column, which in this case is 15 at $7. That's what's still there and has not left. So it's going to be 15 times $7, and that will give us $105 for the ending inventory.